I wasn't even looking at Japan when this caught my attention. I was checking something routine, one of those quick glances you do without thinking. A rate line, a boring update, and then I saw a number that didn't make sense. Japan's 30-year government bond yield had just climbed to levels it hadn't touched since these bonds were first issued in the late 1990s. That alone is unusual, but what made me stop was everything that followed. Suddenly, this wasn't staying in Japan. The yen was under pressure. U.S. Treasury yields were moving. And then came the part that should make anyone pause for a second longer than usual. The U.S. Federal Reserve stepping in, indirectly, to help stabilize another country's currency. That's not a headline you see in normal times. And no, this isn't one of those the world is ending stories. It's stranger than that. It's quieter. The kind of shift that doesn't feel dramatic in the moment, but later you realize it changed how the system behaves. What's unsettling isn't the size of the move. It's where it's coming from and how fast it's showing up elsewhere. I didn't expect to care about Japanese bond yields this year. Most people don't. But when a market that's supposed to be slow, predictable, and deeply domestic starts sending ripples through everything else, that's usually a sign that something underneath has stopped working the way it used to. And once that happens, it rarely stays contained. So before we talk about markets, portfolios, or risk, we need to be clear about one thing: what this story is actually about. This story isn't really about Japan's debt. It's also not a prediction of a crash, a meltdown, or some neatly timed financial apocalypse. What this is really about is something more structural and more uncomfortable to deal with: how decades of cheap money and leverage quietly reshape the financial system until one small shift forces everything to react at the same time. Japan just happens to be where the pressure surfaced first. When funding stays cheap for long enough, behavior adapts. Strategies harden into assumptions. Trades that once looked clever slowly become invisible until they stop working. And when they stop working, the problem isn't the trade itself. It's how much of the system came to depend on it staying intact. So if you're expecting a bold call about what markets will do next, that's not the point here. The real question is simpler and harder. What happens to portfolios, diversification, and risk when the structure underneath them quietly changes? Most coverage stops at the surface. You'll see headlines about rising yields, a weakening yen, a central bank tweak here, a reassuring statement there. It all sounds familiar, almost procedural. Rates move, currencies react, officials speak, markets digest. End of story. But that version leaves out the part that actually drives outcomes. What rarely gets explained is who is forced to act when those numbers move, and who no longer has the option to wait. Markets don't shift because everyone suddenly agrees on a new narrative. They shift because someone, somewhere, runs out of room. A funding line tightens. A margin threshold gets crossed. A trade that used to roll over quietly doesn't. That's the gap. Rising yields, on their own, are not inherently dangerous. Japan has lived with enormous debt for decades. Investors have known the numbers for years. If this were just about information, nothing dramatic would happen at all. Everyone already knows Japan is highly indebted. Everyone already knows rates can't stay at zero forever. What changes behavior isn't the fact, it's the constraint. When a small move forces a large group of participants to adjust simultaneously, markets stop behaving like collections of opinions and start behaving like systems under stress. And that's when correlations that usually protect portfolios begin to fail. I'll be honest, this took me longer to grasp than I'd like to admit. For a long time, I treated yield moves as background noise. Technical, someone else's problem. It wasn't until I started asking who couldn't afford to ignore the move that the picture sharpened. Because once you see it that way, you realize the most important market moves aren't the loud ones. They're the ones that quietly remove options. And that's exactly where this chain reaction begins. Here's the cleanest way to think about what's happening, without turning it into a checklist or a lecture. It starts in a place most people consider slow and self-contained: Japan. For decades, Japan was the anchor of cheap funding, not because it was strong, but because it was stable in its own way. Low growth, low inflation, low rates. That stability created a habit. Money could be borrowed cheaply, predictably, and at scale. From there, that money didn't stay local. It moved outward, quietly, into places that offered slightly better returns. U.S. government bonds, credit markets, sometimes equities. sometimes more exotic corners. The trade itself became so routine that it stopped feeling like a trade at all. It felt like plumbing. Over time, more participants relied on that plumbing working the same way it always had. Not just long-term investors, but hedge funds, banks, and intermediaries who layered leverage on top of something that looked safe. When a strategy works for long enough, it stops being questioned. It becomes infrastructure. And then the pressure shows up, not as a headline event, but as a cost change. A yield moves just enough. A currency shifts just enough. Suddenly, rolling the trade forward isn't neutral anymore. It requires a decision. That's where the chain tightens. Once those positions start to unwind, the movement doesn't stay confined to bonds or currencies. The selling spreads because it has to. Liquidity gets pulled from wherever it's easiest to access. Assets that shouldn't be related start moving together, not because they share fundamentals, but because they share the same funding source. And eventually, that pressure reaches places that feel very far removed from Japan. Tech stocks, pension portfolios, mortgage rates, things people assume are driven by entirely different forces. Once the chain is under tension, it doesn't matter where you're standing. You feel it. To understand why this matters, we need to slow this down and separate what looks dramatic from what is actually doing the work underneath. Japan's debt numbers have been extreme for a long time. Roughly 250% debt to GDP. That figure alone should have triggered concern decades ago, yet it didn't. Not because it was healthy, but because the structure around it absorbed the pressure. For more than 30 years, Japan lived in a world of near-zero interest rates. Growth was weak, inflation was mostly absent, and the government, through the Bank of Japan, effectively capped long-term yields by buying enormous quantities of its own bonds. The market wasn't really pricing risk, it was being managed. That arrangement worked in a narrow sense. Not because Japan's debt was sustainable in a textbook way, but because nothing forced the system to confront it. The cost of carrying that debt stayed negligible. And as long as borrowing costs stayed close to zero, the sheer size of the debt remained an abstract problem. The shift began when the Bank of Japan stepped away from that role. Over 2024 and into 2025, yield curve control was loosened and then abandoned. The BOJ went from being a consistent buyer to allowing the market to discover prices again. That's when something important happened. Long-dated Japanese government bond yields started moving on their own. By early 2026, in places people expect stability. If volatility begins appearing on days with no obvious news, that's often a sign of forced behavior. Selling driven by margin, liquidity needs, or risk limits rarely waits for a headline. It happens quietly, and it tends to cluster. None of these conditions, when assets that are supposed to protect each other begin to move together, that trust deserves a second look. This isn't a call to abandon diversification or to assume it's broken forever. It's an invitation to ask a more honest question. What do you actually consider safe, and why? Is safety a label, or is it a relationship that only works under certain conditions? If bonds don't offset equity risk the way they used to, what role do they play for you now? If liquidity drives prices more than fundamentals during stress, how exposed are you to forced selling? Even if you never use leverage yourself? These aren't questions with universal answers. They depend on goals, time horizons, and tolerance for uncertainty. But they're questions that tend to get postponed until the system asks them for you. So before looking for the next headline or the next trade, it's worth sitting with this. If stocks and bonds can fall together, what does safety actually mean in your portfolio today? If this kind of analysis resonates, consider subscribing. Not because it offers quick answers or confident predictions, but because understanding how the system works often matters more than reacting to whatever headline happens to be loudest that day. Markets change slowly, and then suddenly. The goal here is to recognize that shift before it forces your hand. On this channel, the focus isn't on calling tops or bottoms. It's on explaining the mechanics, how funding, leverage, policy, and human behavior interact over time. Those forces don't show up in daily market commentary, but they shape outcomes long before prices reflect them. If you'd like to keep exploring these ideas, there's a natural place to go next. In the next episode, we'll look at how government debt and currency systems interact when trust starts to matter more than growth, and why those dynamics tend to surface during periods that feel deceptively calm. So if you value calm, structured thinking over noise, hit subscribe. It helps the channel grow, and it ensures you don't miss the next conversation. Because the most important shifts in markets rarely announce themselves. They unfold quietly, until paying attention becomes the difference between reacting late and understanding early.